Should you buy in a trust or should you buy in a personal name? So I get this question every week, and I think I have probably got it every week for the last 20 years. And what we're going to do today is unpack it. Have a look at what a trust is, how it can benefit you, when it won't benefit you, and when it's going to be appropriate for your circumstances. My name's David Thomas from Trilogy Funding, and I've spent the last 20 years helping property investors grow their portfolios and build sound investment wealth. And although trusts sound like a fancy thing and sounds like something you should be doing, for some investors, it's really a case of just over-servicing. So what we're going to have a chat about today is when a trust might be appropriate for you and when it may. So what is a trust? Look, a trust is just an investment vehicle that holds a property on behalf of the beneficiaries. Now, how is a trust structured? So a trust has two main components that you need to be concerned with. Who is the trustee, okay, and who are the beneficiaries? In most cases, property investors will have a proprietary limited company listed as the trustee, and then they will be the directors of the trustee. The trustee is the controlling body of the trust, and that's who's going to make all the decisions, what properties you're going to purchase, and how profits are going to be distributed. The beneficiaries are really who the profits are going to be distributed to later on down the line. Now, there's numerous kinds of trusts. Most property investors look for a discretionary trust where they can distribute the income to the beneficiaries however they would like to, hence the term discretionary. There is also a unit trust whereby the units of income get distributed in a fixed manner. So if you've got two people being unit holders, they would each get equal share. And then the last one is a bare trust, and that is a special trust that is only really used for self-managed super funds. We'll get onto that later on. So why do people use trusts? People use trusts for three main reasons. Number one is asset protection. It's a separate entity that's holding the assets, external from you. If someone sues you, they're not suing your trust. It's a different entity. So number two, tax flexibility. Having a discretionary trust allows you to distribute profits to individual beneficiaries in an uneven manner. The third reason is estate planning. Trust will enable you to disperse assets later on down the track to individual family members in a kind of very long-term estate planning manner. So downsides and limitations. So we've talked about why trusts are good. Let's talk about why trusts may not be ideal for your set of circumstances. And the number one reason is there is no personal tax benefits when you have investment properties held in trusts. For most people that get into investment properties, the one thing that helps them hold the property and buy more properties is they get to claim immediate tax deductions on their negative gearing. As the property is held in a trust, a separate entity, you can't claim the losses on that property against your own personal income. It's a separate entity. If this is cash flow positive, great. You can then disperse it to the various beneficiaries. But for most people that buy residential investment property at 100 or 105% loan to value ratio, the property will initially run at a loss, and that loss is not able to be claimed against your personal income. The second issue with trusts is cost and complexity. So if you're operating a trust and that trust has one residential property in it, then you've got to set up the trust, and you've also got to do a full tax return for that trust and financial statements each year. So the cost to set up the trust might be anywhere between $1,500 to $2,500, and then the tax returns for that trust could be anywhere from $1,000 to $2,000 per year, depending on your accountant and what they charge for the work. So as we've discussed in previous videos, investment property returns are based on your annual holding costs and then what you sell it for in the future. So if you're entering into a purchase in a trust and you have an additional layer of cost every year, that's obviously decreasing your term returns. The third reason is lending limitations. Some lenders really great at trusts, other lenders not so much. And one determining factor is the thing that usually fuels your ability to buy more property is by most lenders having negative gearing add backs in their servicing calculators, adding back in the forecasted tax return that you would get from the negative gearing and holding costs on that property. Now, obviously, if it's in a trust, the lender can't do this. Therefore, it may knock many thousands of dollars out of your serviceable income and therefore reduce how much you can actually borrow when you borrow in a trust. Recently did one of these. We purchased in a trust. The maximum loan amount I could get was $450,000 with a specific lender. If the client was to purchase in their own name, it was actually some $250,000 more. Definitely something to be considered when you're talking about the purchase of a property at the maximum amount or even multiple properties. And the final one to consider is taxation, and if there is things that could potentially be worse from a taxation or cost point of view if put in a trust. The most clear argument for this one is probably land tax in Queensland. So the land tax threshold is at a different level whether you've got the property in your personal name or whether you've got the property under a corporate entity such as the corporate trustee for a trust. So sometimes there is an extra level of tax or levy that is imposed on trusts or properties bought in company names. So buying in your own name, which is usually what most beginner or first-time property investors do go down the path of. And why is that advantageous? Well, as we've talked about before, you get the negative gearing benefits in your own name. This helps and fuels your servicing calculator to get you moving. It avoids costs of extra accounting fees and extra legal fees and potentially extra government fees or state government fees imposed on trusts and corporate borrowers. It's going to make your lending for your first and second properties much simpler and give you a very broad scope of lender choices. Also, it's going to be easy to refinance later on and get better deals on your borrowings, keeping your interest costs lower. Now, of course, with all these things, there is a trade-off. When you buy the property in your own name, it's your name that goes on the title. And if you are self-employed or in a profession that's particularly risky, then having assets in your own name can cause problems later on down the track from a litigation point of view. But for many first-time buyers or beginning investors, having the property in your personal name is actually beneficial to you. Let's have a look at two examples. You tell me which one you think should have a trust and which one shouldn't. So we've got Emma, PAYG teacher, earns $115,000 a year, has her first investment property, and it's negatively geared by $15,000 a year. If Emma has the property in her own name, then she'll be able to get a tax return back of at least $5,000 a year. On the other hand, we have James. James owns a building company. The building company has shares in it held by his family trust. James's company trades profitably, although it does highly risky work, and it distributes its profits into his family trust. So, should James buy in a family trust? Well, he's got income that flows into it, and having the asset in his own personal name may come with a degree of risk. So as you can see, whether you need a trust or should you have your property in a trust or should you have your property in personal names comes down to your personal circumstances and situation. Usually when you weigh things up on paper, it becomes pretty self-evident which one you should be progressing with. So sometimes it actually makes sense to buy in a trust. And the instances where it makes sense to buy in a trust is you may have multiple properties and you're looking for a way to diversify your risk. Having properties held in a second name is a good way to start siloing off things from a risk perspective. As we discussed with James before, you might have a very risky job or employment that you may be liable to be sued or to have any claims against your assets. And having your assets in a different entity is a good way to create some firewall and keep those assets out of harm's way. Also, you've got flexibility for how you're going to distribute income throughout your family. So we take James the builder before. He's distributing into the trust, he's claiming his costs of the property in the trust, and then he can distribute those profits after the deductions to his individual family members at the lowest possible tax rate, which would make sense for James. If you plan on holding this property very long term, and therefore it will get to a stage where it's all paid off and negative gearing's not a concern, then of course having the property in a trust might be advantageous, because the rental income that comes through can then also be distributed to family members at the lowest possible tax rate. And lastly, if you're planning very long term for wealth creation, or you need to buy with other people such as business partners or family members, then combining together under trusts might make more sense. So how do we know if a trust is going to be right for you? Look, a trust isn't a magic bullet that's going to solve all your problems. I'd usually say to clients, don't set up a trust unless you know what problem it is you're trying to solve. So if your goal is to buy 1 or 2 properties, have a little bit of wealth creation, and claim some tax deductions along the way, keeping it simple and having it in personal names is probably ideal for you. But if you have very long-term goals, you plan on holding the properties for a very long term, or you're planning on developing properties, or if you have income sources that may put you in harm's way from litigation points of view, then certainly considering a trust might be the ideal situation. With all of these things, especially trusts, consult with everyone in your sphere before you actually go down that path. Have a chat to your accountant, have a chat to your lawyer, have a chat to your broker, and make sure that all 3 of them agree that a trust would be ideal for your set of circumstances and what it is you're trying to accomplish. So here at Trilogy, we work closely with many people's accountants and lawyers to run the modelling on what a client can do if they buy inside a trust, or what a client can do if they buy outside of a trust, before the client actually goes and commits to going down that path. So if you need someone to run some math and numbers for you and let you know what your options are going to be and whether this could be appropriate from a lending point of view, please reach out and we'd be more than happy to help you. As always, if you found this video useful, please hit like, hit subscribe, leave comments below. It's how we know that we're doing a good job. I'm David Thomas. Thanks for watching, and I look forward to seeing you in the next video.